What I'm about to share could change how you see opportunities in this market. 3 stocks trading for less than your coffee, but analysts are projecting 100%, 76%, and 125% earnings growth. Before you think this is hype, these numbers are coming straight from the analysts themselves. Cheap stocks, big promises, we've heard this before. But these are actual companies with real operations, real revenue, and real catalysts that could deliver exactly what analysts are projecting. If you're serious about finding opportunities before they become obvious, hit that subscribe button right now. At Market Authority, we dig into data and bring you information that makes a difference. Hit that notification bell because the market moves fast. Let's dive in. Here's something crucial. There's a huge difference between a price target and an earnings projection. Price targets are guesses, but earnings growth is the foundation that drives stock prices. When earnings grow consistently, stock prices follow. This earnings season, companies are getting punished even when they beat estimates if they don't beat by enough. The bar is incredibly high. But for these 3 companies, if they deliver on projected earnings growth, we could see serious upward movement. Why focus on stocks under $5? When you find a low-priced company with strong fundamentals and growth projections, you're looking at asymmetric risk-reward. That means substantial upside potential with limited downside. Plus, smaller companies have more room to grow compared to mega caps everyone is already in. These aren't get-rich-quick schemes. Real risk exists, but they also have real catalysts. Let's get into the first opportunity. The first company operates in offshore contract drilling for oil and gas. They specialize in the most complex deep water drilling operations that require expertise most companies don't have. I'm talking about Transocean, ticker RIG. Here's what's interesting. While the broader market got dragged this week, RIG is up 6.8%. When a smaller stock outperforms while big names fall, that's a signal something is happening. What's driving this move? Oil prices are ticking upward. When oil rises to certain levels, companies don't just maximize existing wells. They explore and look for new drilling sites. That's exactly where Transocean comes in. Transocean has been around for a while and has struggled. Revenue has been growing steadily, but converting that into profit was the issue. Then, in their last earnings at the end of October, they delivered their first positive adjusted earnings per share in 6 quarters. Analysts are projecting Transocean will grow earnings 100% from last year. Last year was negative, so they're expecting a swing from losses to meaningful profits. If that happens, it's incredibly bullish for the stock. BTIG Research just increased their price target from $5 to $6 this week. That's a 20% increase. Transocean reports earnings on February 19th. That's when we get confirmation if they're truly on track. Investors will be watching for positive earnings per share growth. They'll also want full-year guidance confirming that 100% growth projection. If Transocean confirms it, the stock could make a significant move. If oil prices continue to climb and exploration ramps up, Transocean is positioned to benefit. They have the fleet, the expertise, and they're finally converting revenue into profit. Before we move to the second stock, hit that like button and drop a comment. Let me know which stock you find most interesting so far. The algorithm loves engagement, and it helps us reach more people looking for this analysis. I read every comment. The second stock takes us to precious metals, specifically gold. Gold recently surged to $5,000 an ounce, then pulled back. Some say gold got ahead of itself in the short term, and that's probably true. Parabolic moves almost always lead to pullbacks. But the fundamental drivers haven't disappeared. Central banks are still buying gold, which puts a floor under prices. Limited supply and currency uncertainty remain major factors. Gold and the dollar also have a strong inverse relationship. When the dollar weakens, gold strengthens. Over the last few days, the dollar softened and gold has started ticking back up. If gold continues grinding higher this year, gold mining stocks become very interesting. And here's why. Miners didn't keep pace with gold's rise last year. That sets up a catch-up trade. When gold rises by a certain percentage, mining stocks often amplify that move. Their profit margins expand dramatically. The company here is B2 Gold, ticker BTG. It's a junior mining company based in British Columbia with operations around the world. It's more growth-focused than major miners like Barrick or Newmont. Junior miners generally have more upside because they're still expanding. Analysts covering B2 Gold are projecting 76% earnings growth. That's a massive number. This projection depends on gold prices staying elevated or moving higher. If gold reaches $6,000 by year-end, mining stocks could see even larger gains. BTG's recent price action is worth noting. Despite market volatility and gold pulling back, B2 Gold is still up 2% for the week. Compare that to TRX Gold, another junior miner we discussed earlier. TRX is down 4.6% for the week. BTG has held support at higher levels. That suggests stronger demand and confidence from investors. Both BTG and TRX are junior miners. TRX has about 50% projected earnings growth. We discussed TRX when it was under $1 and it surged shortly after. Both stocks move with gold rallies and pull back when gold cools. However, BTG's pullback has been far more controlled. The bottom line with B2Gold is simple. You're betting on gold prices continuing higher. Central bank buying, currency uncertainty, and limited supply all support that thesis. If it plays out, junior miners like B2Gold can significantly outperform. There's one more stock to cover, saved for last because it has the highest earnings growth projection, 125%. Before we get there, share this video with someone who's looking beyond big tech stocks. And subscribe to Market Authority, because we break down opportunities most people miss. The third stock is in biotech. What makes this different from typical biotech stocks we cover is that this is not a clinical stage company burning cash while waiting for FDA approval. This company already has drugs on the market generating real revenue. It's not profitable yet, but having products selling significantly reduces risk compared to pure research biotechs. The company is Ironwood Pharmaceuticals, ticker IRWD. They focus on gastrointestinal diseases and are not a GLP-1 drug company. They operate in a different area of the GI space, addressing real medical needs with products already generating revenue. So what's driving the bullish projections? They have a drug currently in phase 3 clinical trials. Phase 3 is the final stage before applying for FDA approval. It's the large-scale testing the FDA requires, making it a critical milestone. If this drug succeeds and gets approved, it becomes a major catalyst for revenue growth. Here's what really caught my attention. Ironwood recently increased their revenue projections for the next 12 months by 40%. That's not a small revision. That's a company telling investors demand is exceeding expectations. When a company already generating revenue says it expects 40% growth, something meaningful is happening. Analysts are projecting 125% earnings growth. Since the company isn't profitable yet, this implies a swing from losses to potentially significant profits. But unlike pure clinical stage biotechs where everything hinges on trial success, Ironwood has already proven it can bring products to market. The remaining challenge is converting growing revenue into profit, and analysts believe they can. Having existing products removes much of the binary risk typical in biotech. It's no longer an all-or-nothing bet where approval makes or breaks the company. Ironwood has diversified revenue from current products. That provides a foundation while new drugs move through the pipeline. Let's bring this together. These are 3 very different companies operating in 3 different sectors. Transocean is an offshore drilling play tied to rising oil prices and increased exploration. B2Gold is a junior miner leveraged to gold prices staying elevated or moving higher. Ironwood Pharmaceuticals is a biotech with existing products and a major phase 3 catalyst ahead. What ties them together is simple. All 3 trade under $5. All have substantial analyst projections for earnings growth. All have clear, identifiable catalysts that could drive earnings higher. These aren't random penny stocks. They are companies with real operations, real revenue in most cases, and real reasons analysts expect earnings to grow. But I need to be clear. These are higher risk opportunities and come with volatility. Stocks at this price point can move up quickly. They can also move down just as fast. Do your own research. Understand your risk tolerance. Never invest more than you can afford to lose, especially in smaller cap stocks. I'm providing information and analysis to help you make informed decisions. What you do with it depends on your own goals, portfolio, and risk profile. My job is to highlight opportunities most people aren't looking at. I also want to give you the context to understand what's actually happening. Transocean reports earnings on February 19th. That will be a key moment to watch. If they deliver positive earnings and confirm guidance, that could be the catalyst pushing the stock higher. For B2Gold, keep an eye on gold prices. If gold continues grinding higher, BTG should benefit. For Ironwood, watch for phase 3 updates and revenue guidance. Those will be the signals investors focus on. Focusing on earnings growth matters more than price targets. Earnings growth is what drives sustainable stock appreciation over time. Price targets are guesses, but consistent earnings, growth forces stock prices higher. So which of these 3 stocks do you find most interesting? The energy play with Transocean, precious metals with B2Gold, or biotech with Ironwood? Drop a comment and let me know. If you want a deeper dive on any of these, tell me which one. If you made it this far, thank you for sticking through this breakdown. That tells me you're serious about understanding the market and finding opportunities early. Subscribe to Market Authority because we'll keep bringing detailed analysis on stocks that deserve attention. Hit that notification bell so you don't miss what's next. Successful investing isn't about following the herd. It's about finding opportunities before they become obvious. It's about understanding fundamentals, recognizing catalysts, and positioning accordingly. Transocean, B2Gold, and Ironwood Pharmaceuticals represent exactly that kind of setup. Will all of them work out? Nobody knows for sure. But they have real drivers and analyst support that make them worth watching. Keep learning, keep analyzing, and keep looking for opportunities others miss. I'll see you in the next video. Until then, stay informed and stay ahead.